Have you ever really stopped to think about what it means to own a stock? It always sounds so complicated, right? Like it's some kind of Wall Street secret. But today, we're going to peel back the layers and show you that it's all about one simple but really powerful idea: ownership. So let's get into it. Just think about this for a second. What if you could own a tiny piece of the company that made your phone, or the coffee shop you go to every morning? That is exactly what we're talking about here. Owning a stock makes you more than just a customer. It actually makes you an owner. So here's the game plan for this explainer. We're going to start with the absolute basics. What even is a stock? Then we'll get into the two main ways you can make money from them. We'll look at the big picture, the long-term potential, get real about the risks involved, and then wrap up with maybe the most important part of all, the investor's mindset. All right, first things first, let's really define what a stock is. We need to stop thinking about it as just a number blinking on a screen and start seeing it for what it truly is: a partnership in a real, living, breathing business. Okay, so here's the bottom line. A stock, you'll also hear it called a share, it just represents a slice of ownership in a company. When you buy even one single share, you become a shareholder. You literally own a tiny fraction of that entire business, and you get to be part of its future, for better or for worse. You know, it's really a two-way street. On one side, you've got the company. For them, selling stock is a way to raise money or capital so they can grow, build new things, and innovate, all without having to take out loans. And then there's you, the investor. For you, it's a chance to partner with a business you actually believe in. Okay, so you're a part owner of the business. That's cool. But how does that actually pay off? How does this whole partnership thing put money in your pocket? Let's break down how you actually see a return. Well, it really boils down to two main ways, two primary paths that your ownership can pay you back. The first way is the one pretty much everyone thinks of. The price goes up. We call it price appreciation. So if the company you invested in does well, it grows, makes more profit, becomes a bigger player in its field, the value of your little slice of ownership can go up too. If you sell those shares for more than you bought them for, that profit is called a capital gain. Simple as that. Now, the second way is through something called dividends. Think of it this way. If you were a part owner in a local pizza shop and it had a fantastic year, you'd expect to get a cut of the profits, right? Well, dividends are the exact same idea, just on a much bigger scale. It's the company sharing its profits directly with its owners, with you. And this is why dividends are so awesome. For one, they can give you a steady stream of income, but you can also take that dividend money and use it to buy even more shares of the company. When you do that, you create this incredible snowball effect called compounding, where your earnings start making their own earnings. It can really accelerate your growth over the long haul. So you've got the price going up and you've got dividends coming in. Let's put those two things together and look at the big picture: why stocks have been such a powerful way to build wealth over time. This simple formula here is everything. Your total return isn't just one or the other. It's the combination of how much the stock's price grew, plus all the dividends you collected along the way. That's what gives you the full, true picture of how your investment actually performed. And when you look at that total return over many years, you really start to see why people invest. Stocks have historically shown really strong potential for growth, which makes them a go-to tool for building long-term wealth. Plus, they can help protect your money from inflation. I mean, as prices for everything go up, successful companies tend to grow and raise their prices too. But, and this is a really, really important but, we have to be honest here. That potential for great rewards always, always comes with risk. We absolutely have to look at the other side of the coin. Because it's so true. The market doesn't just go up in a straight line forever. Investing has never been and will never be a guaranteed path to riches. It's just not a one-way street. So here's the trade-off you're making. The upside is growth, right? You get to participate in the success of great companies. But the downside is what we call volatility. Share prices can jump all over the place, sometimes pretty wildly. And that means there's always the potential for loss, especially in the short run. So let's be crystal clear on the key risks. Number one, share prices can go down, sometimes sharply. Number two, unlike a savings account, your returns are never, ever guaranteed. And number three, those dividends we talked about, they aren't set in stone. If a company hits hard times, it can cut them or get rid of them completely. And all of this brings us to our final section, which might just be the most important one of all. You see, the biggest challenge in investing often isn't about picking the right stock. It's about controlling your own emotions. It's about having the right mindset. The market's ups and downs can play some serious tricks on our brains. When things are going down, fear kicks in. It can make people panic and sell everything, turning what was just a temporary loss on paper into a very permanent loss in their bank account. And on the flip side, when things are great, overconfidence or greed can make people buy in at the very top right before a fall. So what's the antidote to these emotional traps? Well, it really comes down to these three things. First, patience. You have to think in years and decades, not days and weeks. Second, discipline. You need a plan and you have to stick to it. And third, emotional control. You have to understand and accept that ups and downs are just part of the game. They're not a signal to freak out. This quote really just ties it all together perfectly. Stocks connect investors directly to the performance of real businesses. At the end of the day, remember, you're not just buying some random ticker symbol. You're investing in a real company, its people, its products, and its future. Which leads me to this final thought. When you buy a stock, the real investment you're making isn't just your money, it's your patience, it's your discipline. So the question to ask yourself isn't just, do I have the money to invest? It's, do I have the patience to see it through?